Are you leaving hundreds, even thousands of dollars on the table for the IRS every year, simply because you're sitting on investment losses? What if I told you those very losses, those red numbers staring back at you from your brokerage account, could actually be a potent tool to reduce your tax bill right now? You're looking at what seems like a financial setback, but savvy investors see a strategic opportunity: tax loss harvesting. Let's break down the two paths you can take when an investment sours. Option A, the do-nothing approach. This is the default for most people, and it's entirely understandable. When an investment goes down, it feels bad. We often avoid the pain, hoping it comes back, or feeling paralyzed. So, you hold it, an unrealized loss on your statement, taking no action. Here's what most people miss about this approach. You don't realize the loss, meaning no tax benefit. If you have other investments that did perform well, perhaps you sold winners earlier in the year, or received capital gain distributions, you'll owe full taxes on those gains. The loss you're holding onto does absolutely nothing to offset them. It's a missed opportunity. You're paying full taxes on your wins while your losses sit dormant, providing no financial upside. You're essentially leaving money on the table for Uncle Sam that you could legitimately keep, all by utilizing the tax code exactly as it's designed. Consider a simple scenario. You sell some Apple stock for a $5,000 gain. Great, but you also have a position in a small-cap tech fund that's down $5,000. If you do nothing with that tech fund, you pay taxes on the full $5,000 Apple gain. If you're in the 15% long-term capital gains bracket, that's $750 in taxes you're paying out of pocket. If you're in the 20% bracket, it's $1,000. That's cash straight out of your pocket that you could have potentially avoided paying. Option B, strategic action. Tax loss harvesting. This is where smart investors turn a setback into an advantage. Tax loss harvesting is the practice of selling investments at a loss to offset capital gains elsewhere in your portfolio and potentially even a portion of your ordinary income. It's a completely legal and legitimate strategy to reduce your current year's tax liability. Here's how it works. No fluff. When you sell an investment for less than you paid for it, you generate a capital loss. The IRS allows you to use these capital losses in specific ways. 1. Offset capital gains dollar for dollar, the primary benefit. If you have any capital gains from other investments you sold during the year, whether short-term or long-term, you can use your capital losses to directly offset those gains. Example, you have $10,000 in capital gains from selling XYZ stock. You also have $8,000 in losses from selling ABC fund. You can use that $8,000 loss to reduce your taxable gains down to just $2,000, $10,000, $8,000. You've just shaved off a significant chunk of your tax bill. 2. Offset ordinary income. But here's a powerful feature that often gets overlooked. If your capital losses exceed your capital gains for the year, you can use up to $3,000 of those net losses to offset your ordinary income, things like your salary or business profits. Example. Let's say you've used all your losses to offset gains, but you still have a $3,000 net capital loss left over. You can deduct that $3,000 directly from your taxable income. If you're in the 24% marginal tax bracket, that $3,000 deduction just saved you $720 in taxes. $3,000, 0.24. That's real money back in your pocket. 3. Carry forward indefinitely. What if you have more than $3,000 in net losses after offsetting all your gains? No problem. Any unused capital losses can be carried forward to future tax years, indefinitely. This means even a substantial loss can continue to provide tax benefits for years to come. This isn't some niche strategy for the ultra-rich. Market volatility is a constant. The S&P 500, for instance, has experienced average intra-year declines of approximately 14% since 1980. This isn't just theory. Losses are a common, unavoidable part of investing, but knowing how to leverage them is key. Now, before you rush to sell, there's one critical rule you must understand: the wash sale rule. This rule prevents you from selling a security at a loss and then immediately buying it back just to claim the tax deduction. Specifically, if you sell a security for a loss, you cannot buy that same security or a substantially identical security within 30 days before or after the sale date. If you do, the loss is disallowed. This means you need a plan. You can sell a stock, take the loss, and then buy a different but similar ETF or mutual fund to maintain your market exposure, or simply wait the 31 days before repurchasing the original security. For example, if you sell an S&P 500 index ETF like SPY for a loss, you could immediately buy a different S&P 500 index ETF from a different provider like IVV or VOO to stay invested. Let me give you a real-world example. A few years ago, I bought into a promising biotech stock that, to put it mildly, cratered. I was down about $7,000 on that single position. Instead of holding on to it, hoping for a miracle that wasn't coming, I sold it. That $7,000 loss was immediately put to work. I had some gains from selling a different stock that had performed well earlier in the year. The loss wiped out those gains, saving me over $1,000 in capital gains taxes. Plus, I was able to use the remaining loss to offset the maximum $3,000 of my ordinary income that year, saving me another few $100s. I then reinvested the proceeds into a broader biotech ETF, maintaining my sector exposure without violating the wash sale rule. It was a tough lesson on stock picking, but a valuable win for my tax situation. This isn't about admitting defeat, it's about optimizing your portfolio. It's about being proactive and using every tool at your disposal to maximize your returns, post-tax. By harvesting losses, you're essentially deferring taxes, allowing that capital to stay invested and grow for longer, instead of being sent to the IRS prematurely. The verdict. Tax loss harvesting isn't just a strategy for high net worth individuals. It's a fundamental component of smart, tax-efficient investing that every investor should understand and consider, particularly as the end of the year approaches. It allows you to take lemons and, if not make lemonade, at least use them to wash away some of your tax bill. It shifts the burden of taxation, putting more money in your pocket today or in the future. Don't let emotion or inaction cost you legitimate tax savings. Your actionable takeaway. So what should you do today? 1. Open your brokerage account. Right now, review your taxable brokerage accounts for any unrealized losses. Identify positions where you're significantly down. 2. Check your tax snapshot. Estimate your capital gains for the year. Have you sold profitable investments? Do you expect mutual fund distributions? These losses can directly offset them. 3. Plan your moves and talk to a pro. If you find opportunities, map out potential sales and replacement investments, keeping the wash sale rule in mind. While straightforward, consult a qualified financial advisor or tax professional before making significant decisions. This video is for educational purposes only and does not constitute financial advice. Don't let those red numbers intimidate you. Understand them, strategize with them, and turn those investment losses into tax wins. The money you save in taxes is money you can reinvest, allowing your capital to compound further. It's a no-brainer if you want to optimize your financial future. If you found this breakdown valuable, hit that like button, subscribe for more no-nonsense financial advice, and share this with someone who needs to hear it. Because being smart with your money isn't just about making gains, it's about minimizing losses, especially when it comes to taxes.